There are several key economic themes that we see driving global markets. Firstly, inflation has been and is remaining low almost everywhere. This is due to a number of factors. Some are cyclical, including below-trend economic growth, low wages growth, and falling commodity prices. Structurally, new technology that are disrupting existing business models are also putting downward pressure on prices and are likely to continue to do so. In addition, the demographics of aging populations are also acting to keep inflation low. Globally, all major central banks target inflation at around 2%. The question now is whether 2% is now too high a target in the post-GFC world. And do we need a real debate about inflation targeting regimes? The second factor is exceptionally easy monetary policy. The US Federal Reserve's interest rate cycle is now expected to be even more gradual than originally planned. While many other central banks, like the People's Bank of China, the Reserve Bank of India, the Reserve Bank of New Zealand, and our own RBA, are expected to cut interest rates further this year. The extreme end result of these rate cuts is the advent of negative interest rates. Globally, 5 central banks now have negative interest rates: the European Central Bank, Japan, Switzerland, Denmark, and Sweden. The ECB cut rates to minus 40 basis points in March, and more cuts are likely to come. The Bank of Japan is also expected to cut interest rates further from the current minus 10 basis points in the months ahead. Taken literally, negative rates fundamentally invert the basis of banking, with depositors charged interest and borrowers paid it. This has led to concerns around bank profitability globally. Political risks are also on the rise, with the US election and UK referendum on EU membership adding to an already uncertain outlook. Donald Trump and Hillary Clinton are almost certain to be the presidential candidates for the upcoming US elections. While opinion polls consistently show that Hillary Clinton is the favourite to win, as we have seen, it is dangerous to underestimate Donald Trump, who represents significant uncertainty as an untested political outsider. The UK's referendum on EU membership, to be held on the 23rd of June, introduces significant uncertainty to global financial markets. The UK maintains important trade links with the EU, with almost half their exports destined for Europe. In the event of a vote to leave, the final relationship between the UK and EU will be unclear for a period of 2 years following the referendum, while the post-Brexit negotiations are finalised. This is likely to weigh on both markets and businesses. Indeed, the British pound has already weakened, with pound assets coming under pressure as markets react to the Brexit uncertainty. While there are some risks to global markets and economies, there are also some positives. Global economic growth in 2016 is expected to be slightly better than last year, with the International Monetary Fund, better known as the IMF, expecting global growth to increase from 3.1% in 2015 to 3.2% in 2016. While this is still significantly below pre-GFC levels, it is a sign of the continued, if moderate, global recovery. Growth in 2016 is likely to be led by the US, with some recovery in Europe. Japan appears to remain soft, and China's growth should moderate further to around 6.5% this year. Given lower commodity prices and the strength of the US dollar, there are risks to emerging market growth. Despite this moderate global economic growth, the good news is that the unemployment rate continues to fall across the major economies. Continued job creation is being supported by very low wages growth globally, limiting the upward pressure on inflation from tightening labour markets. Global commodity prices have been under significant downward pressure, driven by the oversupply of key commodities in the global economy. Having said that, we are seeing some signs of more balance in key commodity markets. The oil price has also been impacted by geopolitical events in Saudi Arabia and Iran, as well as supply-side disruptions such as strikes in Kuwait and the fires in Canada. It is worth noting that low energy and oil prices generally tend to be positive for the global consumer. Recently, we have also seen more balance in the iron ore market, which is positive for exporters such as Australia and Brazil. In the US, the Federal Reserve is achieving its dual mandate of full employment and price stability. The unemployment rate has now fallen to 5%, well down from the GFC high of 10% and consistent with the Fed's full employment target. The Fed's preferred measure of inflation, the Core Personal Consumption Expenditure or PCE, is at 1.6%. This is likely to begin putting pressure on the Fed to gradually increase interest rates. The US Fed began the long-awaited policy normalisation in December 2015 by increasing interest rates for the first time since 2006. The Fed has stressed this process will continue, but will be very gradual and data-dependent. As of March, the Fed's expectations of interest rates, known as the dots, imply only 2 rate hikes in 2016, well down from the 4 they previously expected in December 2015. Our own expectation is for 1 or perhaps 2 rate hikes this year, potentially in September and/or again in December. It's worth noting that the market is expecting no rate hike this year and just 1 by 2017. We expect US interest rates to peak at just 2.5% in late 2018 or 2019. Despite higher interest rates in the US, we expect global monetary policy to be easier at the end of 2016 than the start. The Bank of Japan enhanced its QQE program in December 2015, then surprised markets in January 2016 by cutting rates into negative territory, the 5th central bank globally to do so. We also expect more easing in the months ahead. The European Central Bank QE program started in March 2015 with its asset purchase program at 60 billion euros per month and increased this to 80 billion euros per month in March this year. The asset purchase program now includes sovereign bonds as well as investment-grade corporate bonds. The program was also extended by 6 months from September 2016 to March 2017 in an attempt to fight deflation. We also expect further easing in China in order to address the challenges it is facing on a slower economy, equity and property market volatility, and capital outflow and currency depreciation. Australia is also likely to follow the global trend of easier monetary policy this year. Despite the unemployment rate trending down, the RBA eased by 25 basis points to 1.75% on the 3rd of May. Another rate cut to 1.5% is expected in the short term, with a further move to 1.25% likely before year end. This was prompted by unexpectedly low inflation in the March quarter of 2016 of just 1.3%. The underlying rate of inflation was also below expectations at 1.55%. This is significantly below the Reserve Bank's 2 to 3% target range and led the RBA to lower their inflation forecast by 1% for 2016 to a forecast range of 1 to 2% and cut the end of 2017 inflation forecast by 0.5% to a range of 1.5 to 2.5%. All this means that interest rates are likely to remain low by historic standards for some time. US interest rates, which include both the Fed funds rate and bond yields, have been very low relative to nominal GDP growth since the 2008 GFC. This is likely to persist for many years to come and the best illustration of the new normal. Whatever the level of nominal GDP growth, inflation, the level of interest rates, and the return on investments associated with that growth will likely be lower in the future than the past. Globally, bond yields have been forced lower by this phenomenon and the QE programs and further central bank easing around the world. Moderate economic growth, falling oil prices, and low inflation are also holding bond yields down. Worries about the effects of negative interest rates have also been driving the direction of bond yields. Having said that, with US Fed rate hikes, we could expect some pickup at the shorter end of the US yield curve. For much of 2015 and into early 2016, the Australian dollar had been depreciating against a stronger US dollar as commodity prices fell and also against a weaker Chinese backdrop. The trade-weighted index, however, which reflects the AUD against a basket of currencies, had been more resilient due to weakness in the British pound, euro and Chinese renminbi. For much of March and April, the Australian dollar trend reversed, with the AUD heading higher on the more gradual US Fed interest rate hike expectations, easier global monetary policy and an improved trend in commodity prices. The RBA noted that this stronger Aussie dollar complicated the economic outlook and the economy's transition away from mining-led growth. However, the early May interest rate cut from the RBA and expectations of a further narrowing between Australian and US interest rates has seen the Aussie dollar resume its depreciating trend. A further downward move in the Australian dollar is expected in the months ahead. Concerns over the global economy and the impact of negative interest rates led to a sharp correction in equity markets earlier this year. However, equity markets are expected to be supported by further central bank policy easing and the fact that economic fundamentals are probably stronger than what the markets are implying. That said, continued central bank policy divergence, political risks, and the uncertain global outlook are likely to lead to an increase in volatility in the year ahead.